Without a doubt, it's one of the weakest spots in the U.S. economy, and we're talking about the housing market. Home prices are continuing to fall, and foreclosures are back on the rise. But are the numbers as bad as we might have expected? Karen Weaver runs market strategy and research at Seer Capital. She was a top-ranked analyst by Institutional Investor when she headed securitized products research over at Deutsche Bank, and she joins us now back in studio. Karen, good to have you back with us.
Good to be back.
I remember when your report came out and talked about what 42% of U.S. borrowers would be underwater. I think it was summer of 09, perhaps?
Is that right? Yeah.
Where are we in terms of underwater mortgages?
Right now, it's probably about 30% or so of borrowers that are underwater.
That's pretty bad.
It is pretty bad. It's certainly totally unprecedented, and it's part of the problems that continue to plague the economy.
Do we get to the 42%? I mean, is the worst? I think we keep continuing trying to figure out if the worst is over for housing.
You know, unfortunately not. I think we're all a little bit tired of it, and we'd like to think that it is, but it tends to be a cycle that plays out rather slowly, which can be a good thing. The other thing is that government policy has somewhat slowed down and ameliorated the crisis, and that's made it feel like a pause, but we think home prices still have further to fall.
It's funny you talk about government policy. I mean, I think we'll continue to debate whether it's good to have government intervention or just to let the cycle correct itself. Where are you on this? Do you think it's good to have the government involved here and maybe help it along?
Well, I think if you look back to the worst parts of the crisis, really the nadir of the crisis, I think it was prudent for the government to try to slow down the decline in home prices, because home prices are so much about psychology, and you're having this sort of downward spiral that feeds on itself. And so I think
the tax credit was a good idea.
Well, the two things really that they did. They pulled some demand forward, sort of borrowed demand from future years by offering a tax credit that caused people who might have otherwise waited to go out and buy. So that helped bring some demand forward. They also pushed out supply, in effect, by requiring modifications and having some people who might have otherwise been foreclosed upon and their homes would have hit the market. They've sort of delayed that process. And I think the combination of those two things is really why you saw home prices, you know, they went down a cliff and then they sort of started to moderate and climb up a bit. It was government policy. And probably for the worst part of the crisis, it made sense to sort of slow things down a bit. But we don't have a planned economy. The government cannot control home prices. And now we're sort of returning to our regularly scheduled programming, which is home prices are still not at the right level.
When do you think we bottom out? Is that just, I mean, I know we ask it ad nauseum at this point, but I mean, do you have any indication? Is it 2, 3, 4 years out? Well,
with the important caveat that it depends upon the next step, if there are any in government policy. I tend to think that we're not going to see anything dramatic in government policy, and it's probably going to be running its course from here. And it's also very much market by market. But with those two caveats, you know, it's probably another year to 18 months because it's so long for these foreclosed properties to be resolved.
You know, we talked about government. I mean, would you like to see the governments get involved again? I mean, again, it's highly unlikely. But do you think would you like to see the government involvement again?
Well, from what standpoint?
Yeah, I guess so. Many would argue they helped create the crisis and the situation.
Certainly they did. But, you know, if you look at, for example, the whole discussion about what should happen with Fannie Mae and Freddie Mac with the GSEs, to what extent does the government belong in the housing market? The fact is that, strictly speaking, those entities should be drastically cut back. But right now, they provide 95% of the mortgages that are being granted out there. So we don't have the luxury of deciding right now we're going to sort of normalize the housing market and do the right thing, because there's too many other things moving in the market. So I think the government should continue to support Fannie and Freddie and slowly wean us off those. But other policies, I just don't think that they're going to be terribly effective.
Karen, if we could fast forward 5 years from now, 10 years, what is the housing market going to ultimately be like? I mean, is it going to be very different from what we've known over the last few years here? And I'm not just talking crisis, but you know, the expectation that your home value just goes up and up and up.
Well, hopefully we've nipped that in the bud. I think some of the entire conversation around homeownership in this country has been distorted by these concepts of housing as being primarily an investment. And I think a very strict accounting of being a homeowner and what that costs, and the foregone cost or foregone income on your down payment, et cetera. In many cases, if you don't have a high inflationary environment, housing is not a tremendous investment. It's really a place to live. So I think we've probably wrung some of that out of the process. But going forward, when you look at the housing market, one of the issues is, as we were just alluding to, is if the government is going to be pulling out of the housing market to some extent, which both sides of the of the political debate agree to, then that means at some point the housing market is going to be suffering from less demand, from higher mortgage costs. And so even when we improve, we have that to deal with.
A lot to deal with.
Yes.
Karen, great to have you back here in studio. Karen Weaver at Seer Capital. We're taking a break. We're back in a moment.